Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for our April posting. It's our 47th, and the Municipal Market Update is a monthly posting that we do so that our clients and other market participants have a general idea of what's taking place in a municipal marketplace. Fieldman, Rolapp Associates is a municipal advisor to government, and my name is Adam Bauer. I serve as CEO and president of Fieldman, Rolapp Associates. Our last posting was one of the most action-packed postings since we started. We had bank failures. We had what looked like possibility shifts in interest rates, where we've been trending a bit upward, and it looked like we might be trending lower. And it really was one of those fundamental changes. So now you come into April, and it really has been relatively quiet since then. I've thought about this posting and thought the March postings like playing the best team in your league, and then the next week, why certain things are better. You're playing a team that isn't quite as competitive for you, and that's where we are in April. But let's get into the update, and like I said, we'll continue to monitor things as they progress. This first slide here, we showed you this for the first time in March, and if you really want to start with the right vertical axis, and then what those relate to are the green bars. The green bars represent the Fed funds rate increase. So if you go to the right, you get to 25, you look at that March of 22, that was that first increase. Then you had a 50, then you had 475 increases, then a 50, then 225 increases. All of those aggregate into that yellow line. And you can see that yellow line is about 4.75. So anytime there's a green bar, that shifts that yellow line upward. Now, in the November, or maybe it was the December MMU, I talked to you about how when the Fed chair, Jerome Powell, spoke in November, the interpretation, I believe, was that rates may need to go up more, and they may need to stay high for a while, but the 75-point increases were likely done. And I think that was the investor interpretation. Rates went down a bit. And the reason why I bring that up now is that 10-year Treasury, when I think investors were convinced that rates would just keep going up, it really tracked the Fed funds rate. You can see as that went up, so did the 10-year Treasury. You really see a break from that when that November meeting took place. And so now you've seen it go up and down, but it doesn't look stable the way I'm looking at it now, but from November, it's not that far off from where it was then. It's just a little bit lower. And so the 10-year Treasury of a lot of other interest rates are based off of that with some sort of spread, or at least the 10-year Treasury is taken into consideration. And so that's why we layer that in there as well. But this is a chart you'll continue to see. Like a lot of financial charts, it starts trying to simplify something, and then we layer so many things into it, it gets a little complex. But I'll continue to walk through it each month, and hopefully that'll be helpful for us all, having a grasp for what's taking place. This chart, what we're trying to show you is the US Treasury. We go from years 1 through 30. The blue line represents 1/3/2022. If you've seen the MMU a few times, this is the point that I've talked a lot about, where investors went from inflation is transitory to maybe not. Keep in mind, the Fed doesn't start increasing rates till March of 22, but rates started going up this first Monday or Tuesday in January of 22. But still, not too much. You can see here, they did not have a lot of time to adjust. But now fast forward to April of 2023, and that's this lime color line. And that's how interest rates have changed in that period of time. You've gone from a more traditional yield curve where rates start off low and they go up, to an inverted yield curve. And I've told you before in MMU, there's all sorts of thoughts on that. Generally, it's a recessionary sign, but Google that or whatever search engine you want and kind of get some ideas on what an inverted yield curve may cause. But we do have, this is what a yield curve looks like, an inverted yield curve. This other chart I find very interesting because it shows you that the MMD, municipal market data, and that's one of the measurements we use to track municipal interest rates. And I'm looking at the 30-year here. The one thing I think is important is the shorter term maturities have gone up in a greater fashion. So even though I'm showing you the 30, keep in mind the shorter term rates have gone up. If you go back to this chart, you can see that. Look at the 30-year. It's gone up from 2% to just under 4%. Where if you go to the 1 year, you can see it's like 0.5 up to what's that 4.8. So keep that in mind, looking at the 30-year, but that has not adjusted as much as some others. But in that March timeframe, we had a decline in interest rates in January. So at February 1st, we had a negative 0.37 from the month prior. But we gave all that back in March or in February. By March 1, you can see all but 1 basis point. If you look at January 3rd to March 1 there, we're 1 basis points difference. But then we got a lot of that back in March. If you look at April 3rd there, you see a negative 0.26, which means there's been a decline in interest rates. And that really was kicked off with a lot of those bank failures. And then, everything kind of calmed down since then, but certainly a positive movement for municipal issuers. Now here is that AAA MMD yield curve, and I have every one of the maturities here, years 1 through 30. That AAA MMD range, that light greenish color, what that represents is the MMD for each one of those maturities going back to 2005. And so you see quite a big range there. What that bluish line represents is the MMD for each one of those maturities on 4/14/2023. So on those shorter term maturities, like years 1 and 2, you can see we are above average. We're above like the midpoint on that. But hopefully what you notice is years like 4 through 10, we're a little bit below average. And then after that, we're below average, but not to the same degree. And so this gives you a good indication is even though rates feel like they're a lot higher than they have been, and they are, on a historical perspective, they're still within the average type range. Put a lot of colors and charts on this chart, but on this page, and we will run through it pretty quickly. But what we're trying to show here, and for 23, we don't have full year data. So for example, if you look at the top left chart, there's only a light blue line through March, because obviously we haven't completed April yet. And but one thing I'm hoping jumps out about that chart is the volume appears to be down significantly, and I'll get to some reasons for that. But that you can hopefully notice that the light blue line is lower than some of the other years there. Then to the right of that, you see a negotiated versus competitive versus private placements. And these are different methods for selling bonds. One thing I think we're going to see in 2023 is a lot less private placements. A lot of the regional banks who are now trying to preserve capital with some outflows, and we talked a bit about that in March, will likely not be as interested in locking up their funds with private placements. And so I think you'll see the issuance volume really be focused on negotiated and competitive sales for 2023. That's something I'll continue to bring up to you. We should watch, but that is an interesting development because we certainly the direct placements, or otherwise known as private placements, have been a valuable tool for issuers over the last few years. The bottom left chart there, taxable versus tax exempt there, you can see 20 and 21, a lot of taxable. I think a good portion of those were refundings, so that there's a tax bill that went in place in 2017 that did not allow for advanced refundings to be done on a tax exempt basis, so they're done taxable. But rates got so low that we're able to do taxable refundings to refinance tax exempt bonds. That was likely the anomaly for a year or two, and we're not likely to see that in the near future. But I think that's what you're seeing there, is you're seeing a real decrease in the number of taxable issues, in large part because they are not available for refundings. Now to the far right there, what we're showing there is our funding versus new money. And you can see volume is down from the chart before, but look how much less there are in refunding. So if you go to 2020, 21, you can see we were at 31 and 23% of the volume was refinancings. Now I'll go to the far right there, you can see it's like 16%, 22 is 13%. And that's a big reason why there's been a real decrease in volume, is not having those refundings out there to do. Now, the inflows and outflows, red means, I'm sorry, green means money's flowing into the municipal bond funds. Yellow means money's flowing out. Municipal bond funds are big purchasers of municipal bonds. And you can see it's kind of a mixed bag, trending out since January of 22. But we've had some months where it trends in. This is an important factor to watch. One thing we haven't been able to get real good data on is SMAs, separately managed accounts, have augmented this to some degree. They've had funds flow in, and which have somewhat augmented some of the municipal bond funds, but we don't have real good ways of showing that yet. But we see them showing up on a lot of municipal bond transactions. But a general trend towards less interest in municipal bonds than we've had in recent months. And another sign, just to show you how volume is down, I think the line charts, or the dotted line charts, get some pretty good perspective there. 2021, you can see it just under that 10 billion mark. Then 2022, you're a bit below the 8. And then finally in 2023, you're just at the 6.3. So pretty significant change in volume. But these bar charts, what they're showing is volume is up a bit in recent weeks. So I'm not sure if that's a long-term trend or not, but there's more bonds being brought to market than there have been in recent weeks. Our economic calendar is listed here. Certainly items to watch. Anything that comes in unexpected will likely have an impact on the municipal market. And then finally, I'll leave you with our registered municipal advisors here. I encourage you to reach out to any one of them for more information or specifics on a transaction. I thank you for your time, and I look forward to posting again in May. If you have any questions, or you have anything that you think we can do better with in this, or that you would like to see, please send me a note at abauer@fieldman.com. And Bauer is B as in boy, AUER. So it's abauer@fieldman.com. We welcome feedback. We are posting this for our clients and others, and we want to make sure we're giving you something that is meeting your needs. Thanks again for your time.